Towards the end of last year, we were discussing the risk of a dollar rally for several reasons. Two of those reasons were the market expectations of Fed rate hikes, which were extremely low, and US short positioning, which was extremely high. Since then, the dollar did bounce, and from where we stand now, we think the risks are to the other side, to a weaker dollar to start the year. So, first of all, dollar positioning has moved from extremely short to roughly neutral, particularly against the euro. And Fed rate hike expectations for this year at least are somewhere between 2 and 3, where we expect 3, so there's not a huge repricing that needs to be done in the front end. In addition, in the first half of the year, the US data tends to disappoint compared to expectations. There's a strong seasonality in US surprise index, which isn't evident in other countries' surprise data. So this should weigh on the dollar to start the year.
So when we move from the first few months of the year and look at a little longer term in terms of the dollar, we still hold to the view that it's really much more of a euro story going out the next 12 to 18 months than it is a dollar story per se. When you look at the level of interest rates, short-term deposit rates in the United States versus Europe, how both areas are growing, the ECB has a lot more to do in effect in terms of moving from negative deposit rates to positive rates, and that, as well as the growth that that obviously implies, should be a positive for the euro. And that's really going to be, we feel, the driving force on the euro in the coming year. So, as I said, it's more of a euro story. Now, there is one aspect where it does become a dollar story, and that has all to do with the change in the tax law that now drops the tax rate on repatriated dollars for American firms to 14% from 36%. As a result, the expectation is that there will be a flow of dollars from corporate accounts that may be held in dollars, much of which may not be held in dollars, back to the United States. We do not expect this flow to come anywhere near the size or have the impact that it did in 2004. First of all, at that time it was a 1-year window, now it's an 8-year window. Also at that time it was clearly a tax holiday because there was a zero tax cost, and now there is, as I said, a tax cost of about 14%. So I think what this does is there'll be an initial flurry of money moving in the first quarter, but after that, when we look at the $3 trillion that's overseas, and that's growing as the global economy grows, when we look at that $3 trillion, I think what the tax law does is it gives firms time to optimize where their assets are best kept. It's really a very difficult thing to say in the aggregate that means that the dollar should go in one direction or another. And I think, as Ollie, as you've said before, that the shift in the dollar from other places can also affect dollar funding, because there is a lot of banks around the world do use those dollar deposits as collateral against which to make loans.
And so that's the other risk factor to our view, that offshore dollar liquidity is extremely dependent on the price of the dollar. And so far there hasn't been any signs of the cost of this liquidity going up, but if there were to be a reduction in the availability, either through repatriation or through an increased cost, for example through Fed hikes, then this may cause a rally in the dollar as there's a funding scramble from offshore borrowers. So that's one risk factor that we'll be watching closely in the coming year.